Stocks are back at all-time highs and markets keep shrugging off risk. So is this rally actually justified, or are investors missing what matters most right now? Carol Schleif is Chief Market Strategist at BMO Private Wealth. She joins us now. Carol, great to have you.
Thanks for having me. Really appreciate it.
So stocks are modestly lower today, but still very close to those all-time highs and up big for the month of April. Carol, what's the market getting right here, and what might it be missing?
I think the market's definitely getting right the focus on fundamentals. We've seen it come through in the early read on earnings. Part of today's pullback might be that we've got a very big earnings day coming on Wednesday and Thursday, with 5 of the Mag 7 reporting this week. And as I heard this morning, something close to $30 trillion worth of market capitalization reporting on a single day. But when you look back at what's reported so far, there's big chunks of the financial services industry that have reported with aggregate bottom line advances of close to 25%. You've got big chunks of the industrials that have reported, and you're seeing order backlogs. There's solid fundamental underpinnings to where the markets have gone. And if you look at the first quarter performance, we were pretty flattish in the market, even while earnings were advancing by that double-digit amount that we suspect you'll see for when all of first quarter's reported. And so the fundamental underpinnings are really there, setting aside some of the potential concerns. Now, that said, the other part of your question was what tail risks, either super positive or super negative, might the market be ignoring? And one of the things the market has desperately tried to move beyond is the conflict in the Middle East. You could see potential long-term impacts that come through in terms of higher costs, stickier inflation, things like that. But we tend to think that much of that will be offset by productivity and savings from technology, not just AI, but also from other margin maintenance expertise that companies are showing us that they're doing.
So would you say that the fundamentals actually justify stocks at these levels right now?
I think stocks should grow into the stock valuation should grow in. There's been a lot of hand-wringing recently, not just recently, over the last number of years. There's been hand-wringing about where the earnings, the relative multiples have gone. We're not at all like we were in the late 90s, because I lived and managed money through those periods where we're rearranging the way we're valuing stocks. But, it does feel it's hard for a lot of people to take, especially if some unknown event comes out or unpredictable event comes out. You're seeing the nervousness in the market, and you're seeing the market climb that wall of worry, but which is actually positive in the long run. But anytime you have full valuations like this, it does mean that you're priced for perfection in any sort of unexpected event that occurs, whether it's a tweet or a social media post or an unexpected event. If a ship went down in the Strait of Hormuz, there could be some market pullback that would react to that.
And you've said that the real signal this earnings season in particular isn't what companies say, but what they don't say. So what is it that you're looking for, and what would be a red flag to you on that front?
I think one of the things we're probably watching the most closely is, as we deploy AI and robotics and technology, how big do the cuts get in employment? Because we've got a very consumer spending dependent economy. It's been driven by not just the top tier, but primarily by the top several tiers, if you will. And they need to have confidence that they can stay employed. And so we're watching that piece a lot, what companies are saying. It used to be when companies would announce that they were cutting heads or offering extended retirement or early retirement programs, it used to be that the stock prices would get hit. But now investors seem to be rewarding companies that are showing that margin discipline and not hiring at will. That is one of the factors. It's very different than the late 90s, because there was a lot of hiring going on, a lot of workforce participation that was going on, lots of things factoring in that way. So the key will be are technology companies in particular, do they start expanding their layoffs, particularly of white collar engineers, those typically higher paying jobs? Because if you aggregate all those up and roll them up, you could see some concern that we would be watching for that way. Also watching for M&A, capital expenditure expectations. I think one of the reasons why markets will likely stay pretty quiet and volatile going into the Wednesday reports this week is everyone's trying to figure out, are we excited that companies are expanding on AI, or are we not excited? We'll also want to listen. It's one thing to say how much you're going to spend on data centers. It's another to say how far along are they? Can you turn the electricity on to them to actually power them? And so there'll be a lot that the street watches for, particularly as the rest of the Mag 7 reports this weekend, next week.
And the bar is pretty high given the rally that we've seen in a lot of the Mag 7 over the past couple of weeks. So how much of the AI trade do you think is already priced in? And if the easy money has been made, where does the next leg of growth come from?
I think it's important to remember that we've still got that broadening trend that's been in going on since the beginning of the year, where you've got the broader Russell 2000, you've got if you look at the S&P 600, you look at small and mid cap, they're holding their own and really broadening out. You've got Mag 7 finally basically flat to up a little bit for the year, but you've got those smaller cap stocks up 10 or 12%, playing a catch-up trade. And so for the sustainability of the rally, you really need to see that trade continue, if you will, the broadening out continue. And we do think you can see it, because if you look at industrials, for example, in order to really drive this next move towards Industrial Revolution 4.0, you need infrastructure build here, you need manufacturing build out. And as investors, we can only invest in a very small handful of names there, because industrials are, I think, less than 10% of the S&P representation. And so we need to see that broadening out, and a lot of those are smaller and mid-sized stocks as well.
I'm curious about what your clients are actually doing at these highs. They're high net worth individuals, of course. So are they leaning in right now at this moment in time, or are they starting to pull back?
I think we practice what we often call portfolio hygiene here, in terms of trying to actively rebalance as we go through. You've had opportunities this year to take some losses in particular names and reposition in other names as well, because of the volatile markets that we've seen. So, but through all of this volatility in here, we've communicated a lot with clients just to make sure that we knew where their heads and where their feelings were at. It's a similar replay to what you had not only last year, but you had it in COVID. You had it with the start of the Ukraine-Russia war. You've had this first quarter shock in 4 or 5 of the last 5 or 6 years, where the first quarter has had that. Markets have pulled back and then pretty quickly recovered and ended the year higher. And so clients overall we've had many of them for a very long period of time are used to this sort of ebb and flow. And so while they might think nervously, it takes a lot of communication, if you will, just to reassure them that the diversification we have in portfolios is serving them well.
Talk to me about that diversification. Where are you putting money right now? What do you want exposure to? What do you not want exposure to? Dig in there.
I think what we would like exposure to as we continue, we've remained overweight equities with a growth bias. We've continued to like the United States and North American markets, if you will, given that we're owned by a Canadian bank. There's a lot to like about Canadian markets as well in there. And so we've maintained that bias, thinking that North America in particularly if energy prices stay high globally, the price of oil stays above where many strategists thought it would, particularly at the start of the year, North American entities are better positioned to be able to absorb those sorts of issues, because both Canada and the US are net exporters of of energy. They're impacted nonetheless, and consumers are definitely impacted. But we like that growth. We also think emerging markets are interesting play. We want to take more of our risk budget, if you will, in the equity market as opposed to fixed income. And we tend to be a bit shorter fixed income, thinking that it's been a nice ballast in portfolios. You've probably got, we do think you'll see a rate cut or two by the end of the year, because we do think that while inflation may not get back to the Fed's 2%, they'll be watching pretty carefully what's going on the employment side of the equation.
What's the signal for you that this market has gone from strong to stretched?
I think it would continue to be, if we would see more, you would see investor sentiment in particular become less skeptical, and everyone wants all in and all in on the US market. You would see more blow off tops. One of the things we're watching as well is you do have some exuberant trading going on in semiconductor stocks, and we remind clients all the time that technology in general and semiconductor stocks in particular are still cyclical industries, even if we're in the midst of a secular cycle. So there would be a exuberance. The other thing we watch closely, it would be to see if there's some over leveraged part of the economy or the globe that gets unweighty or unruly and things happening there. And we don't think you're seeing that yet. We think the fixed income markets are being well disciplined. Companies in particular in the stock market are showing a lot of discipline in how they're managing their margins, how they're handling all of the variety of shocks that have been handed to them. And so we remain really constructive on those fundamentals. The other thing would be if you started to see intense deterioration in the fundamentals, such that energy prices really did slow things, or small businesses started closing in a major way, because small and mid-sized businesses do the bulk of hiring.
What does really constructive look like in terms of returns? What sort of, the S&P 500 is up, almost 5% year to date. How much higher can it go?
Well, I think, we don't set formal record or formal estimates, if you will, for the S&P, but at the start of the year, but one of the local papers that I do a year-end review for every year, we looked at where we ended last year at around 6,900, and if pressed for them, I would do an estimate of around 7,700, most likely for the S&P, which was something like a 10 or 12% return from where it was at. And that sort of return you could justify for a variety of reasons. It was a little nerve-wracking when everything pulled back as it did in the first quarter, much the same way as last year, because we had set around a 6,900 estimate last year at the beginning of that year. But I think the market could continue, because you've got double-digit earnings growth projected through the end of the year, and just keeping valuations pretty steady. Someplace in there, there's a variety of estimates, someplace in that mid 7,700 level for the S&P.
Just quickly, would you put new money to work right now, or would you wait for the Mag 7 to report later this week? And we do have a Fed announcement as well, although it doesn't seem like there's big expectations for any change there. But would you be comfortable buying right now?
Well, I think I would be comfortable buying this week. I would probably, given that we're in a week, I would probably want to wait and see if we got some sort of market movement for this week. But studies do show that putting the bulk of the money in sooner rather than later, even if you pick the high of the market every year, given that markets tend to go up the bulk of the time, putting money to work and not leaving it on the sidelines, despite what your gut may tell you. That said, someone who's just liquefied in a business and it's their first exposure into the markets, it makes a lot of sense to dollar cost average in over some period of time that a new client is comfortable with, because the last thing you want to have happen is put it all in. You have some major announcement that pulls markets down, because we've seen markets able to move 4 or 5% in a day.
Okay, I think this is a great time to pivot to our rapid fire game of this or that. Quick questions, quick answers. Are you ready?
Yep. Bring it
Here we
on.
go. Stocks at highs, justified optimism or complacency?
Justified optimism.
Investors right now, smart or naive?
Oh, I think smart. And the one thing is retail investors have gotten the short end of the stick for years. And I think retail investors have been right a lot in the last 5 years because buying the dip has definitely worked.
Momentum, healthy breakout or getting stretched?
A little bit stretched, but I think momentum, the trend is your friend and tends to be there until something major disrupts it.
Okay, so buy the breakout or wait for a pullback?
Oh, dollar cost average in and round up those dollar cost averages even more on a pullback.
Rebalance now or let winners run?
I think definitely rebalance and having a steady program to rebalance periodically always makes sense.
Growth or value from here?
Growth, we still believe in growth.
US or international?
U.S. U.S. primarily, but also some exposure, especially to emerging markets and things going on there. We would prefer probably non-European, but there's a lot of interesting things going on in Southeast Asia, and you've got talks coming up with China that will refocus investors there.
Energy spike, ignored or priced in?
Pieces of it are priced in. It depends on how long it lasts and how soon we get Hormuz open.
Big tech after earnings, rally or sell off?
I think big tech probably flatlines, if you will, holds its own because it needs to absorb the gain, but the valuations on big tech tend to be quite inexpensive, if you will, relative to a lot of other things because they've definitely grown into supporting their earnings.
Fed meeting, market moving or non-event?
I think it's a non-event. It'll be a curiosity for those of us who geek out listening to it because everyone wants to know if Powell's going to stay on, and he'll dance around that issue.
Fed funds rate by year end, higher, lower, or the same?
I think pretty close to the same to a little bit lower because we do think the Fed will have reason to cut by later this year, but you're going to see headline inflation stay sticky because of what's going on in the Middle East.
Labor market, low hire, low fire, or real layoffs starting?
I think you may hear headlines that suggest that the firings are increasing, but we think you have to look beyond that because you'll have layoffs, you'll have attrition will take more. We don't think you're going to see a massive accelerating firings like you saw in the late 80s or the early 90s.
Consumer, resilient or cracking?
I think resilient, definitely. Consumers are always pretty resilient.
And we know the answer to this one, but I have to ask it for this part. S&P 500 by year end, higher or lower from here?
I definitely think we'll see it higher than when we're at here because new highs tend to beget more new highs, and there's a lot of reason economically and fundamentally to believe that we'll see some good markets between here and year end.
Even if oil remains elevated, and at what point does that change your view?
I think even if oil remains elevated, now our BMO economists have run a variety of scenarios, and even with energy at $80 or $90 a barrel for an extended period of time, it only impacts growth by less than 0.5%, the overall GDP growth. And so I think there's a lot going on because you've got some countervailing trends in terms of tax advantages going on for corporations in terms of rapid write-off of R&D and things. And you've got a lot of support in a variety of industries. You've got some deregulation going on, and you've got encouragement of industries like cryptocurrency and artificial intelligence and things like that. We think that offsets some of the energy input because our society is substantially less dependent on energy. Not non-dependent, but less dependent definitely than it was in the 70s and 80s.
All right, we'll leave it there. Carol Schleif, Chief Market Strategist, BMO Private Wealth. Thanks so much.
Thanks for having me. Have a good day.
If you enjoyed this Street Talk, check out our full interview with Art Hogan. He has a 7,600 S&P 500 target and explains what gets us there.